Hello and welcome along to the Sustainability Uncovered podcast from Edie. This is the monthly show for anyone working in or curious about climate and environmental action in the private sector. Coming up in today's episode, was 2025 really the year that the financial services industry gave up on climate action? The UK Finance Sustainability Policy team give us their year in review.
What we see with our members is that there's still a really strong commitment. We're not seeing stepping back from commitments. In fact, all the institutions I think that we speak to are maintaining their net zero commitments, and actually what we've seen over the past year, particularly building on the work that these institutions have done since 2021 to set emissions reduction targets, publish transition plans, start to offer new green finance products and services, and work with other institutions like governments, is we're actually seeing finance flow more and more.
Yes, hello, and a very warm welcome along to the Sustainability Uncovered podcast from Edie, the UK's longest standing B2B media platform focused on environmental sustainability. You are listening to the voice of Edie's content editor, Sarah, and I'm alone in our podcast studio today because the rest of the team are taking a well-deserved extra few days off before Christmas. But I've already done that, that's why I'm still here. I went earlier in the month for a few days to the Christmas markets in Belgium before they got ridiculously busy, which was a really welcome change of pace and scenery after the November madness, including COP30. So that trip away gave me the headspace I needed to actually properly think about what the past year has brought in terms of sustainability news and how that has in the main impacted everyone working in this field. And as you'd expect from someone in my job, I've had help in doing that by going onto our analytics and looking at what you guys were reading the most on our website this year, both articles and topics. So these have included the SBTi's lengthy process for updating its corporate net zero standard. There was a really lively debate around this about carbon offsetting and measuring supply chain and other scope 3 emissions. Also popular this year, which will come as no surprise, have been stories about the multiple changes to the EU's sustainability reporting and compliance rules as it completes the omnibus process. And then a really standout piece of good news and a welcome trend this year has been the trend towards companies setting and reporting against their social impact commitments, often for the first time. So also permeating our top 20 read stories was the underlying current of what some people have called either the ESG winter or the ESG recession, which has been clearest to see in the energy and financial industries. So while most companies across most industries are maintaining or even increasing their overall sustainability ambitions, we've seen some big rollbacks in energy and finance. So ExxonMobil is among the energy majors really significantly cutting low carbon investment plans after Donald Trump's administration gutted funding for renewables and hydrogen. And in finance, the likes of HSBC and Wells Fargo have abandoned previous decarbonisation goals. The big news in sustainable finance in 2025 has undeniably been the closure of the Net Zero Banking Alliance, which was set up in the run-up to COP26 in Glasgow, but it had seen a huge exodus of members since 2023, despite weakening its requirements in a bid to retain its participants. So the alliance is now just going to act as a library and provider of resources rather than an active membership organisation. But one can't help but ask, beyond these headlines, has it all been bad? And has the bad been pretty concentrated in the USA? For this episode, I spoke with the sustainability policy team at UK Finance to find out. So UK Finance is an organisation which represents around 300 firms in the UK's financial services sector, and it supports them with the tools and resources they need to innovate and stay resilient. So as you'd expect, environmental sustainability is a significant part of that work. This interview is specifically with Agathe Durichon, who is their Principal for Sustainability Policy, and Ian Bhullar, who is their Director of Sustainability Policy. Here is our conversation in full. Thank you both so much for your time. How are you?
Thanks so much for having us, Sarah. Really good. Really excited for this conversation.
Hi, Sarah. Really great to be on the podcast.
Yeah, great to see you both. And if you wouldn't mind, for those of our listeners who haven't necessarily heard about UK finance or maybe what it's doing in terms of sustainability, it would be great to get a brief introduction.
Yeah, sure. Thanks, Sarah. So UK Finance is one of the trade bodies that represents the financial services sector in the UK. We have about 300 members covering a range of financial services firms, from your kind of classic high street banks, retail and commercial lenders, through global investment banks that have operations here in the UK, payments firms, building societies, and fintechs. And our work on sustainability really focuses on the fact that a lot of those 300 members have sustainability commitments of some kind. Some of those are net zero targets, some are sustainable financing targets, and in order to achieve those, they need the right policy and frameworks in place to deliver them. So we advocate on their behalf for clear, stronger net zero policies that help them engage with their clients to get finance for sustainability activities out the door, but also engage with regulators and support knowledge and capacity building among those firms.
Got it. And I'd like to dive into what that has looked like in practice this year a bit more, because at first glance of the headlines, I think anyone that's not in this space would be forgiven for thinking that this sector is genuinely less interested in the low carbon transition, less interested in sustainability. We've seen so much in terms of, the big US banks rolling back some of their targets and the Net Zero Banking Alliance ceasing to exist. But is that really the case for UK financial services, or is it a bit of noise or something that's maybe happening somewhere else?
Yeah, so we've also been watching those headlines with quite a bit of concern, actually, and it's probably worth giving a bit of the history, the short history. I'll keep it brief. But as you referenced, a lot of the headlines over the past year are focused on the Net Zero Banking Alliance. This is an alliance that was set up in 2021. I'm fairly familiar with it because I happen to be part of the team, part of a wider team that helped to set up the Net Zero Banking Alliance alongside the other alliances for financial institutions under the umbrella of the Glasgow Financial Alliance for Net Zero. And really what that group did was, over the past few years, help a whole range of global financial services firms to share best practice in setting targets for net zero, publishing transition plans, setting out frameworks for things like transition finance, and have helped to build the capability in this space. But as you say, over the past year particularly since the US election, we've seen lots of firms initially start to drop out of that alliance. So we saw kind of drumbeat of banks leaving the Net Zero Banking Alliance, ultimately with the decision in October to cease operations. And a lot of the coverage, as you said, of that has focused on a claim that financial services firms have stepped back from their net zero commitments because of that decision to cease operations at the alliance. And we were worried about that really because Agathe and I engage with banks, building societies, and other financial services firms basically on a daily basis. And what we see with our members is that there's still a really strong commitment. We're not seeing stepping back from commitments. In fact, all the institutions I think that we speak to are maintaining their net zero commitments, and actually what we've seen over the past year, particularly building on the work that these institutions have done since 2021 to set emissions reduction targets, publish transition plans, start to offer new green finance products and services, and work with other institutions like governments, is we're actually seeing finance flow more and more. And so what we wanted to do was tell that story a bit to make clear that the industry is still here, and actually we shouldn't let the narrative that the financial services sector is stepping back dampen optimism at a time when we really need as much optimism as we can get. And so Agathe led the work to survey members in the autumn, and I'll let Agathe speak to it.
Thanks, Ian. And it's been a really interesting piece of work for us, I think, working closely with members to really showcase those deals, those products, those services that Ian mentioned. And so what we did was go out to our membership, and we've launched a case study hub called Sustainable Leadership. We think this is really where the industry is playing a role here, and we released that hub at COP30 last month in Belém. And as a side note, I think this is also where you see a lot of the sort of energy coming out from the industry more and the private sector more widely. But so we launched this hub, which covers over 30 examples of deals, activities, services that our members provide, which amount to hundreds of billions of pounds worth of support for clients and the economy at large. I'm going to give a few examples just to sort of set the scene a little bit, but I would really encourage your listeners to go in and have a look at the case study hub. And really what we see in there is huge investments across our membership, which target all areas of the transition and often have a focus on delivering good outcomes more widely, including positive social outcomes. The first example I'm going to be going into quickly is Barclays, for instance. They've provided nearly £250 billion worth of sustainable and transition finance over the past few years. And this is really focused on supporting their clients with their transition, understanding their challenges and how they set out their strategies, which in turn sort of informs Barclays' own strategy and own allocation of capital. So a really interesting example of where and how money flows in delivering the transition. And they also set out the example of their climate venture, Barclays Climate Ventures, which supports a lot of climate tech and startups. So really looking at sort of how do you develop the new technologies that will also support the transition. And we have similar examples from other members in our case studies hub, and really sort of looking at how members are creating frameworks, amping up capacity to understand the transition of their clients and how they can best support that. So really interesting examples. Another example I'm going to go into quickly is Paragon. It's one of our mid-tier lenders here in the UK, and they've provided £15.9 million in development finance to transform a disused industrial estate in Glasgow into a low-carbon neighbourhood. So really looking at a very practical level, how you can support sort of housing and comfortable, warm homes. It delivered 78 homes with an EPC rating of A, fitted with a lot of technologies that look to make homes warmer, more comfortable, and sort of addresses sort of social and environmental issues, which was really interesting to see. Again, we've got a good number of examples in our case studies looking at that sort of warm homes question, and also with a strong focus on social housing in the UK. So would invite anyone who's interested in that to have a look at it. One last example before I hand back to you, Sarah. Wise, which is a British fintech which delivers sort of global money transfers, have a really interesting program. So obviously they are very conscious of their global footprint. They have a 1.5 million climate strategy which focuses on high impact carbon removal projects. And what's really interesting here is like the diversity of the projects, but also how they look at climate and environmental issues in a very systemic way. So also looking to improve the living standards of the people those projects touch. And a good example of this, for instance, we've got a project in Mexico where they are working on regenerating local forests, but they've also trained firefighters to ensure that those forest grounds are safer from fires, but also obviously the huge social impact of creating jobs and training people is also hugely valuable.
And I wanted to touch on a few things that you mentioned there. So you've mentioned an increasing focus on social co-benefits and a systemic approach. So I wanted to ask, so aside from the low carbon transition and net zero, which were definitely like top of the target setting agenda, probably back in the sort of 2019 to 2021 space, what sustainability issues you've seen your members wanting more information on or setting more targets on this year?
One thing I'll say first of all is that clearly we're seeing quite a bit of pushback, not necessarily when we look at data on public opinion, but when we look at political leadership against net zero as a concept in and of itself. And so one of the things that we've seen some of our members increasingly focus on is, to Agathe's point earlier, telling the story of social co-benefits as part of the decarbonisation story as a whole. So the really good example, I think, of that among many is the Paragon low carbon social housing story. You know, you're both delivering carbon reduction benefits through that project, but you're also improving people's lives through creating warmer, more comfortable homes for them to live in. So I think there's a piece here that's really important about social co-benefits, which isn't separate to the core climate policy and climate action story. One other piece that I think is worth drawing out is adaptation, resilience, and climate risk management. And this is really interesting. Clearly, we're in a world now where we're at 1.5 degrees of warming above pre-industrial levels, and we're clearly seeing the impacts of global warming, including through rising incidents of extreme weather, increasing flooding risk in the UK in particular. The financial services sector is very mindful of that. One of the areas that we don't often talk about, but which is worth flagging, is that the banking sector and the insurance sector as well, but we speak for the banks, so I'll focus on that, is probably one of the most heavily regulated sectors in terms of climate risk management. There's been a framework overseen and enforced by the part of the Bank of England that regulates banks, the Prudential Regulation Authority, since 2019, that requires lenders, both banks and building societies, to have in place a range of actions and frameworks to measure their climate-related risk. And that's both the physical risks arising from climate change and also the risks associated with different speeds of transition to a low-carbon economy. That's been really helpful, and it's helped to build capability within the sector to understand and manage that risk. This is quite timely because last week we saw the release of a new supervisory statement from the Prudential Regulation Authority that builds on that 2019 set of requirements and essentially says firms have done a lot to build their capability on managing climate related risk, but there's more to do. And that includes quite a lot of fairly challenging additional requirements, including making sure that boards as a whole are assessing and understanding climate related risk that faces their business. It requires that companies undertake climate scenario risk analysis against a variety of different scenarios of future climate risk, again, both physical climate risk and the transition, and also spend quite a bit of time and energy in developing capability across the business. So in terms of what's coming down the track and what's risen up the agenda over the last year, climate risk and managing climate risk has become a really major issue. There are probably other areas that we can talk about, like nature. I might pause to give Agathe the opportunity to come in.
Thanks, Ian. And yes, I think on nature we've seen a real focus this year and in the past couple of years from our members in developing frameworks and really understanding how nature might be impacting their strategies in the long term, but also how they can sort of mobilize their financing capacity to support nature and biodiversity. We've seen this, I think, in a couple of ways. Firstly, some of our members, some banks have developed their own frameworks and really sort of building capacity internally to understand nature. That also means developing common understandings and standards and metrics as to how we measure nature loss and recovery. And I think what's really important to note here is the influence of some of our members. I'm just going to name sort of Standard Chartered Bank, Bank of America, UBS, and how instrumental they have been in adopting TNFDs.
Great. So lots more to see on that, I think, next year for both the nature topic and the adaptation topic. I'd be surprised if there wasn't more in in the coming months, but something I did want to touch on was something that you mentioned, Ian, which is regulation and how that is changing what members are foreseeing for 2026. So during this year, we saw, for example, the UK government decide not to go ahead with a new green finance taxonomy, along with several other updates in the field of sustainable finance regulation. So how are your members now sort of preparing for the months ahead with the regulatory landscape sort of shifting and evolving quite quickly?
Yeah, so it looks like it's going to be a really busy and quite exciting year for the regulatory agenda. It's worth reflecting on some of the things we've already discussed, like the climate risk management requirements that the Prudential Regulation Authority issued last week, SS 425 in the nomenclature, which will be a really big capability uplift and will mean that banks have to give quite a lot of resourcing to ensuring that they're able to meet the requirements that the Bank of England have set for climate risk management. And Agathe, I think, will talk a bit later on about things like the UK sustainability reporting standards and transition planning. So it looks like it's going to be a really busy year. In that context, one thing that the government chose not to pursue over the past year was the UK green taxonomy. And I think it's worth probably talking a little bit about why that was, what we see as some of the implications of the decision not to proceed with the UK green taxonomy. But overall, the one thing I'd say is, in the context of this busy year ahead, I'm being slightly facetious here, but I think it's fair to say that a lot of our members are probably slightly relieved that there's not one additional quite hefty regulatory issue to deal with in the coming year in the green taxonomy. It's a really interesting one for us. In late 2024, the government issued a consultation on whether to proceed with a standalone UK green taxonomy. There had been an enormous amount of work that had led up to that. I was a civil servant back until about 2022, and I remember when I was in government talking to colleagues about the development of the taxonomy. So taxonomy discussions have been long bubbling away. And our preparation as UK Finance was to engage a lot with some of the thought leaders in this space. The Green Finance Institute ran a lot of work in developing thinking on a green taxonomy. There were lots of international precedents to look at. So we did a big examination of the landscape and also asked our members for views throughout the consultation phase at the end of last year, beginning of this year. And what we found was that actually firms within the financial services sector were quite split on whether a taxonomy would have the use cases that were initially anticipated for it. And so we saw both pros and cons to the decision ultimately not to proceed with the taxonomy, which was announced in the summer. On the one hand, in the pros, some of our members felt that the use cases for a standalone UK green taxonomy were not that clear, and it's worth reminding ourselves. So a taxonomy is essentially a tool that defines what governments consider to be green or not green, and it's useful for financial institutions and investors because it provides a clear benchmark of what green is to label products against. But some of our members, particularly firms that have international exposure, felt that need for them was already filled by the EU taxonomy. So they already had quite a robust framework against which to assess and articulate whether lending and investments they were offering were green or not. Others were quite concerned about the additional reporting that might come with a UK green taxonomy added on to reporting that a lot of them are already doing on the EU taxonomy. And still others, and I think this is quite an interesting argument, were quite concerned about the potential legislative and political time that will be needed to agree a UK green taxonomy, which would take away from developing the real economy policies that we really need to incentivize investment into low carbon activities. And we sort of saw that in the EU with agreement to the EU taxonomy taking several years and lots of bandwidth from legislators both in the EU Council and in Parliament. So a lot of lessons learned from that, and a sense that potentially a UK standalone taxonomy might not be the best use of political time. But on the other hand, we had some firms within our membership who felt quite strongly that a UK-centred definition of what is green or not green would have been quite useful, partly so that they could anchor decisions about how they label products against a UK government assessment of what is green, and that would help them both substantiate their lending claims and also avoid, say, greenwashing issues, so they were really clear about how their products aligned with UK government objectives. And of course, in turn, that then helps with capital allocation. On balance, I think our assessment would have been that proceeding with a UK green taxonomy would probably have been neutral at best. So it's an area where there are still gaps. The decision not to proceed will mean that, you know, some of those firms who would have liked to have seen a UK green taxonomy now need to look for alternative fixes, like developing their own frameworks for how they count green and non-green products. But overall, we're really keen in the year ahead to see progress on the real economy policy that will help to deliver capital for net zero.
And I wanted to ask then, so without that taxonomy providing that clarity from policy or regulation on avoiding greenwashing, but more importantly with actual real economy decarbonisation and change and capital allocation, what clarity can policymakers provide in the months ahead? What is this sector really waiting for before it acts in the new year?
There's a lot that we're looking forward to, as Ian mentioned, in 2026, and that is, I think, the result of a very busy 2025 as well. And I think on a few fronts, and I'm going to start with the wider policy environment. We've seen, I think, really the sort of setting up the few building blocks for a wider framework, and that's in 2025. That's meant sort of seeing the development of the industrial strategy, of the infrastructure strategy, and developing sort of sector-specific investor roadmaps. And maybe Ian will want to talk a little bit about the Warm Homes Plan and what we've done on that topic specifically. Obviously, there's also a lot that we're expecting in 2026 on the regulatory front, as Ian mentioned. Generally, we think the regulatory environment in the UK, especially for financial services, is in a pretty good place. We've got the UK sustainability reporting standards coming in, hopefully in 2026, and that's the result of a lot of work that we've undertaken with government and with the ISSB more generally as well. We've been very vocal supports of endorsing ISSB in the UK. We think it's a very good global baseline, sort of bringing in reasonable requirements for firms whilst providing the sort of proportionate framework and the right tools to help deliver the transition. And it's not just a box ticking exercise. Our members do think it adds value and really sort of helps developing the strategy internally for firms, and not just financial services firm. I think this is where it gets interesting, is that this will be adopted across corporates as well, and this is what our members are really looking forward to seeing, is sort of seeing their clients also develop their capacity for reporting in that area a little bit. We've also got transition planning coming up in 2026 as a really, really big agenda item. We've seen government come out with the transition plan requirements consultation in 2025, which we responded to. And I think it's really interesting because some of our members have been early adopters of transition plans. They've really sort of honed in on strategies, and they've helped shape the understanding of what transition plans could look like and what should be in a good transition plan. They've focused on how do they allocate capital to the transition and how do they best deliver on their own commitments and support their clients in their transition. So I think at the heart of transition planning is a strong focus on supporting clients, and we're really, really hoping to see this in whatever form a transition plan requirement in the UK might take. There's still a lot of unknowns, I think, on how the UK is going to adopt this. And for context, we're expecting both government to consult on a wider strategy around transition planning that would apply to both financial institutions and corporates. And we're expecting the FCA, the financial regulator, to also come up with specific requirements for listed firms. So there's a lot that we don't really know yet about what that could look like, but what we're really hoping to see is considerations on proportionality. And I think there's a couple of things here. It's one, proportionality when it comes to the size of the firm that will have to report or disclose on their transition plans and transition plan related information, but also I think more widely just taking into account the various levels of maturity that we see on transition planning across our sector, but also across the economy. I think a gradual approach is really going to be needed here, because there's still a lot of capability and capacity that needs to be built up. It can be a really useful tool, but there's also a lot of understanding and capacity that needs to be built into firms.
I might just add, if I may, Sarah, two additional things that are really important from our perspective. One of them Agathe has already hinted at, and that's clear investor roadmaps for specific sectors of the economy to support the mobilization of capital. Ultimately, the thing that will really help to ensure that we're driving up investment and lending for low carbon sectors is clear policy frameworks for those sectors and the kind of incentives and support that will corporate firms to make the decision to invest in low carbon changes to their business models, and ultimately also then in turn help investors and lenders to get capital to those projects. And one of the examples on a slightly more consumer basis for us is the Warm Homes Plan. Lots of our members are lenders to individuals to support the purchase of homes through the mortgage market. For a lot of UK headquartered banks and building societies, the housing stock makes up the vast majority of their financed emissions, and to decarbonise that bit of their portfolios will mean that we need to get demand up much higher for installation of heat pumps, installation of insulation, and the other improvements that we need in homes. And so we're really looking forward to the Warm Homes Plan when it's published, hopefully to help kind of stimulate that demand that we think is the key barrier to get finance moving for a greener housing stock.
Got it. I think, as you say, there's still a lot of question marks that we're waiting for, but there are some signals brewing and a lot more to watch in the weeks or even the days ahead, with things like the Warm Homes Plan coming and the circular economy strategy due out next year. So lots having gone on this year, lots ahead in 2026. So thank you both so much for coming on the podcast and taking some time to make sense of some of it with me.
Thanks so much for having us. It's been great.
Thanks, Sarah.
Yes, massive thank you once again to Agathe and Ian for their time. And as they mentioned, you can check out the Sustainable Leadership Case Studies resource on the UK Finance website, or by finding the link via this episode on edie.net. As I hope you'll agree, that was a really fascinating interview, and I didn't want to do it a disservice by cutting it short. So we're splitting December's Sustainability Uncovered episode into two halves. If you're listening to this on the day of release, there won't be long to wait for the second half. I'm going to try and edit it and get it live one day later. So join me in part 2 for more new and exclusive guest interviews, reflecting on 2025 and looking ahead to 2026. We'll specifically be looking at the current state of play in clean tech funding and the ways in which businesses have been striving and struggling to engage their whole staff base with their sustainability work. But for this half of the episode, it's a goodbye from me. Goodbye.